Most people think buying a home in 2026 is impossible, but they are looking at the housing market through a completely broken and outdated lens. You've been told that renting is throwing money away, yet high interest rates make a mortgage feel like you are just signing a deal with the devil. The American dream has shifted into a financial nightmare for millions who didn't prepare for the massive shift in how banks now approve your loans. Are you tired of watching home prices climb while your savings account sits there barely keeping up with the rising cost of living and inflation?
It is frustrating to do everything right, save every penny, and still feel like the goalposts are being moved further away every single month, right?
What if I told you there's a specific debt-free path to ownership that the big banks and your local real estate agents are literally hiding? I'm talking about a strategy that ignores the traditional 30-year trap and focuses on building real equity without becoming a total slave to the bank. This isn't about some get-rich-quick scheme. It is a calculated financial blueprint designed for the current 2026 economic reality we are all living in today. In this video, I will show you how to repair your credit, find hidden inventory, and structure a deal that actually builds your personal wealth. By the time this video ends, you'll have a step-by-step roadmap to move from a cramped rental to owning your own home, completely debt-free. Before we get into the heavy math, we have to address the elephant in the room: your current debt-to-income ratio and why it matters. Lenders in 2026 are stricter than ever before, looking at every single subscription, car payment, and credit card balance you have on your record. If your TTI is over 36%, most traditional banks won't even look at your application without a massive down payment that you likely lack.
But don't panic, because there are ways to fix this quickly if you know which specific debts to prioritize paying off first to boost scores.
If this is already blowing your mind, hit that subscribe button. We go deeper into these financial secrets every single week to help you win.
First pillar of our debt-free ownership plan is the aggressive savings phase, where we cut the fluff and stack cash like a pro.
Most people think they can't save because of inflation, but they're often leaking hundreds of dollars into invisible expenses that provide zero real value. We are going to use the rule of 750 to find exactly where your money is going and how to redirect it toward your home. Imagine taking those wasted dollars and putting them into a high-yield account where they actually work for you instead of for the streaming services. But here's what they don't tell you: saving for a down payment is only half the battle in this current high interest rate environment. The interest rate you see on the news isn't actually what you'll pay if your credit score is stuck in the mediocre 600s range. In 2026, a 1-point difference in your mortgage rate can result in you paying over $100,000 extra in pure interest alone. That is money that could have gone toward your retirement or your kids' college, but instead, it's just padding the bank's massive annual profits. To get the best deal, you need to treat your credit profile like a high-stakes game where every single move is being tracked and analyzed. So what actually happens to your money when you carry a balance on your cards while trying to apply for a mortgage in this market? It creates a risk flag in the bank's automated underwriting system, which can instantly disqualify you before a human even sees your loan application. You need to learn the ASIO method, all zero except one, to optimize your revolving utilization and force your credit score to jump up quickly. This simple trick can boost your score by 30 to 50 points in a single billing cycle, potentially saving you thousands on your house. But having a perfect credit score is useless if you don't understand the difference between good debt and bad debt when buying a home. Still with me? Good. Because this part is where most people lose thousands of dollars by choosing the wrong type of mortgage for their goals. The traditional 30-year fixed mortgage is the most popular choice, but it is actually designed to keep you in debt for your entire life. In the first 10 years of that loan, almost every cent of your monthly payment goes toward interest, not the actual house you're buying. If you want to be debt-free, you have to look at the 15-year fixed option or a specific strategy called early principal reduction. Most people shy away from the 15-year mortgage because the monthly payments are higher, but the long-term savings are absolutely life-changing for families. Imagine saving $200,000 just by slightly adjusting your lifestyle to afford a higher monthly payment today for a better tomorrow.
But what if I told you there's a way to get the flexibility of a 30-year loan with the speed of a 15-year one?
It is called bi-weekly payments. By simply splitting your monthly bill in half and paying every 2 weeks, you make one extra payment yearly. This one simple shift can shave 5 to 7 years off your mortgage without you ever feeling a significant pinch in your monthly budget. However, before you even think about the mortgage, you have to find the right property in a market that feels like a battlefield.
But here's what they don't tell you. The best houses are often the ones that never even make it onto the public listing websites.
Finding these off-market deals requires you to step away from the apps and start building relationships with wholesalers and local real estate investors directly.
Wholesalers find distressed properties and flip the contracts to buyers like you, often at a price much lower than the current retail market value. You can also look for sale by owner listings that aren't on the MLS, where sellers are trying to save on agent commissions.
This gives you direct negotiation power with the owner, allowing you to structure deals that a traditional real estate agent might actually advise against.
So it's a true win-win?
Exactly.
Imagine negotiating a seller carryback, where the owner actually acts as the bank, allowing you to bypass strict traditional lending requirements and high fees. In a seller finance deal, you pay the owner directly, which can lead to lower interest rates and a much faster closing process for everyone involved. But before you sign anything, you must conduct a forensic home inspection to ensure you aren't buying a money pit that will ruin you. Most buyers only check the basics, but in 2026, you need to check the sewer lines, the electrical load, and for any hidden mold growth. Spending an extra $500 on a specialized inspection today can literally save you $50,000 in major structural repairs down the road.
Now, let's talk about the earnest money trap that catches so many first-time buyers off guard and causes them to lose their hard-earned cash.
Earnest money is your good faith deposit, but if you don't have the right contingencies in your contract, the seller can legally keep it all. You need an inspection contingency, a financing contingency, and an appraisal contingency to protect your deposit at every single stage of the home buying process.
Without these, if your loan falls through or the house appraises for less than the sale price, you are essentially just giving the seller free money.
Speaking of appraisals, did you know that the bank's valuation of the home is often very different from what you and the seller agreed upon?
This is called an appraisal gap. And in a hot market, you might have to cover that difference in cash right at the closing table.
That is why having an emergency fund that is separate from your down payment is the most critical rule of debt-free home ownership in 2026.
Many experts suggest having at least 6 months of living expenses tucked away in a high-yield savings account before you ever make an offer. This protects you from the house-rich, cash-poor syndrome, where you own a beautiful home but can't even afford to fix a broken water heater. Ownership is about freedom, not stress, so we build the foundation of our wealth on liquid cash and solid equity, never on thin air. But wait, what actually happens to your monthly payment if property taxes in your area suddenly skyrocket next year? Most people completely forget to calculate this. Property taxes are the silent mortgage killer that can turn your affordable dream home into a financial nightmare faster than a market crash can. In states like Texas or New Jersey, your tax bill could actually equal 20% of your total monthly housing cost every single month you're there. Always check the assessed value versus the market value, because the city will reassess your new home price the moment the deed is finally recorded. This means your monthly payment could jump by hundreds of dollars just months after you move in, destroying your carefully planned debt-free budget and savings. To avoid this, you must look for tax abatements or homestead exemptions, which can legally shield your home's value from these massive annual price hikes.
Now, let's talk about the escrow account and why you might actually want to manage your own taxes and insurance instead of letting banks do it. When the bank manages your escrow, they often over-collect just in case, essentially taking an interest-free loan from you every single month of the year. By opting out of escrow, you keep that cash in your own high-yield account
earning interest until the very day the tax bill is actually due. This is a pro-level move that requires discipline, but it puts you in the driver's seat of your wealth rather than being a passenger to banks.
However, even with the best tax strategy, your debt-free journey will fail if you ignore the hidden costs of homeowners association fees and their rules.
HOAs can fine you for the color of your door, the height of your grass, or even where you park your own car every night. These fees can increase at any time and are legally binding, meaning the HOA can actually foreclose on your home if you refuse to pay. Before buying in an HOA community, you must review the CC&Rs and the reserve study to see if the association is actually financially stable or not. If the reserves are low, expect a special assessment, a one-time massive bill for roof repairs or pool maintenance that could cost you thousands of dollars. If you're learning something real here, smash that like. It genuinely helps more people find this and avoid these expensive traps that ruin many families. Now, let's pivot to the debt-free part of our ownership guide. The strategy of house hacking to make your property pay for its own mortgage. By renting out a basement, a spare room, or an ADU, you can offset your entire housing expense and live for free while building equity. This is how the wealthy buy real estate. They don't use their own income. They use the income from the asset itself to pay the bills. Imagine owning a $400,000 home and having your monthly out-of-pocket cost be zero because your tenants are paying the bank for you. But here's the danger. Most people pick the wrong house for hacking and end up with a tenant from hell who destroys their entire property. To avoid the tenant from hell, you must implement a rigorous screening process that looks far beyond just a simple credit score or a paycheck. In 2026, professional tenants know how to game the system, so you need to call previous landlords, not just the current one, to get the truth. Your goal is to find a tenant who treats your property like their own, ensuring your journey to debt-free ownership doesn't become a legal battle. Now, let's talk about the equity acceleration phase, where we take that extra rental income and apply it directly to your mortgage principal immediately. Most people spend their rental profits on lifestyle upgrades, but if you want to be truly debt-free, you must stay disciplined and stay focused. By applying just $1,000 extra per month to a typical mortgage, you can pay off a 30-year loan in less than 12 years. This is the wealth snowball effect. As your principal drops, the amount of interest you pay every month also drops, accelerating your progress even further. According to the Federal Reserve, the average American homeowner carries debt for most of their lives. But you are now choosing a different path. You are choosing the path of lien-free living, where no bank can ever take your home away from you, regardless of what the economy does.
Still with me? Good, because this part is where we discuss the hidden equity inside your home that you can use without taking a loan.
Most people think the only way to get cash out of a house is a HELOC, but that just adds more debt and more risk. In 2026, you should look into shared equity agreements, where investors give you cash today in exchange for a small piece of future appreciation.
The best part? There are no monthly payments and no interest because it's an investment in your property's value, not a traditional loan from banks.
You can use this cash to renovate your property, increasing its value even further and creating a forced appreciation loop for your personal wealth.
Forced appreciation is the secret weapon of real estate millionaires. It is the process of making the house worth more through smart, targeted improvements.
But be careful. Don't over-improve for your neighborhood, or you will never see a return on that investment when it comes time to finally sell. Always check the comps or comparable sales in your area to see the maximum price a house like yours has actually sold for recently. This ensures you are making data-driven decisions rather than emotional ones, which is the cornerstone of building lasting financial freedom in the USA.
Wait, before we move to the final steps of ownership, what actually happens to your title if a scammer tries to steal your home's equity?
It's called title theft, and it is one of the fastest growing crimes in America, but there is a simple way to protect yourself forever. Title theft occurs when a criminal uses your identity to forge a deed, and take out massive loans against the equity you worked for. You must sign up for title monitoring services or check with your local county recorder's office to see if they offer free property alerts. This simple layer of protection ensures that no one can record a document against your home without you receiving an immediate notification on your phone.
Protecting your title is just as important as paying the mortgage, because without a clean title, you don't truly own your American dream property.
Now, let's dive into the debt-free finish line and how to handle the final years of your mortgage to maximize your tax benefits. As your interest payments decrease, you lose the mortgage interest deduction on your taxes, which might actually increase your annual IRS tax bill slightly.
This is where you shift your focus to energy-efficient upgrades that offer federal tax credits to offset that loss of the interest deduction.
Upgrading to a heat pump or adding solar panels not only lowers your monthly utility bills, but also provides a direct dollar-for-dollar tax credit.
According to current 2026 tax laws, these incentives are at an all-time high, making it the perfect time to future-proof your debt-free home. But wait, there is one massive mistake people make once their home is paid off that can lead to losing it all in a lawsuit.
When you own a home free and clear, you become a target for predatory lawsuits because you now have a massive amount of exposed equity.
If someone trips on your sidewalk, they could sue you and go after the house, since you no longer have a bank's protection or debt.
To prevent this, you need an umbrella insurance policy that covers you for millions of dollars in liability beyond your standard homeowner's insurance limit.
For just a few $100s a year, an umbrella policy provides a massive safety net that keeps your hard-earned equity safe from everyone.
This is the final step in the Fortress of Wealth strategy, building layers of protection around your assets so they can never be taken away.
Most people stop at the purchase, but the elite finance masters know that holding and protecting the asset is where the true wealth remains.
Now that you are debt-free, you can take the thousands you used to spend on a mortgage and invest them into the S&P 500. Compound interest on those mortgage-sized monthly investments will turn you into a multimillionaire much faster than you ever thought possible in your lifetime.
You've officially moved from being a renter to a homeowner, and now from a homeowner to a truly wealthy individual with zero housing debt.
Know someone making this money mistake? Share this video. You might literally save them thousands by showing them the debt-free path to ownership today.
Now, let's talk about the inheritance trap. How to ensure your debt-free home actually stays in your family for the next generation without legal headaches. If you simply leave your home in a standard will, your heirs might have to go through probate, which can take years and cost thousands. To avoid this, many American families are now using a living trust to transfer property ownership instantly and privately without any court intervention at all. A trust keeps the government out of your business and ensures that your debt-free asset remains a blessing for your children rather than a burden. So what actually happens to your home's value if the 2026 market takes a sudden dip right after you finally pay it off in full?
The answer is absolutely nothing, because you aren't selling. A debt-free home is a fortress that provides shelter regardless of what the volatile market.
While your neighbors are panicking about their underwater mortgages and high interest rates, you are sleeping soundly knowing your roof is paid for and safe.
This is the ultimate financial peace of mind. The ability to weather any economic storm because you have eliminated your largest monthly expense from your life. But don't stop there. Use your newfound cash flow to build a legacy fund that can pay for your grandchildren's education or future business ventures.
Still with me? Good, because we are about to enter the final countdown of the strategies you need to amass to stay debt-free forever in America.
The next strategy is cash flow reinvestment, taking the property tax and insurance savings you've accumulated and putting them into high-growth, tax-advantaged retirement accounts immediately.
By maximizing your Roth IRA with your former mortgage money, you are essentially building a tax-free fortune that the IRS can never touch during retirement.
Imagine having $1 million portfolio and a paid-off home by the time you reach 55. That is the new American dream for the smart investor.
Most people will work until they are 70 because they stayed in the debt trap, but you have found the exit ramp to early financial freedom.
However, you must remain vigilant against lifestyle creep, the tendency to buy more expensive things just because you have more cash available every month. Keep your expenses low and your investments high. This is the golden ratio that separates the truly wealthy from those who just look rich. You don't need a Ferrari to prove you're successful. The deed to your home and a 7-figure brokerage account are the only proof you need. According to data from the Survey of Consumer Finances, the primary driver of wealth for the middle class is, and always has been, home equity.
By mastering this guide, you aren't just buying a house. You are building a multi-generational legacy of financial strength that will last for decades to come.
But wait, what is the final, most important piece of advice that Warren Buffett gives to every single homeowner in America? It might surprise you. Buffett famously said that a 30-year mortgage is the best instrument in the world, but only if you use it to outpace inflation and build equity. The secret is to never treat your home as a piggy bank. Don't pull money out for vacations when the market value of your property rises. True wealth comes from the discipline of staying the course, ignoring the noise of the market, and focusing on the long-term goal of total ownership. You have the roadmap, the strategies, and the mindset required to dominate the 2026 housing market and come out on top as a debt-free owner. Don't let fear or high interest rates stop you from starting. The best time to plant a tree was 20 years ago. The second best is right now. Take the first step today by cleaning up your credit and setting aside that first $1,000 for your future down payment. Your future self will thank you for the sacrifices you make today when you are sitting in a home that you own, completely free and clear.
If this guide changed your perspective, smash that like, subscribe for more finance secrets, and share this with someone who needs to hear this truth.
Check out our next video on how to invest your first $10,000 to build a massive stock portfolio alongside your debt-free home journey. I am here to help you win the money game. Stay disciplined, stay focused, and I will see you in the next video very soon.